So what we can see technically. Now I look at the long period. Okay, so from 2004. Now why did I do it? Because look, in 2006, 2007, before the recession, it's reached the point of $46. Okay, somewhere here again, and then it becomes the support level. Very often, whatever was a resistance, it might become a support, and that's where we approach into this level. It's actually one time already touched this level, okay, and I'm going to show you. So that's in the long term, and that's what we can see. The price went up, and this is a huge fall from $90, nearly $90, okay, and then it holds this position. So it doesn't fall lower than this level, about $48, $50, okay, in this particular period. Okay, let's have a look at closer range. That's what we can see. We can see still the highest points, they're going lower, they're getting lower, and the lowest point is getting lower. But at the same time, this level, around $48, one touch, second touch, third touch, fourth touch, fifth touch, sixth touch. Okay, so it's several times already rebounds from these levels. And he broke through it just before the election. After election, it went all the way up. Okay, and then now we can see it's kind of small downtrend. So it's like one wave, and then second wave, and now it's on the second wave. Looks like going to go down. Now, this level, this is a long kind of trend. Okay, so it's several times within 1.5 years, it's touched these points and rebounds. So it's a strong level. And if it holds below that, so we might see for some time share price will be below this level. But if it stays above, most likely it will pull like the price up. Okay, so that's using technical analysis. So that's why pay attention to that, what is going to happen. So quite easily it might go one wave, second wave, and might repeat the third wave. So, and also we can see indicators, they're neutral. So they're not clear for us right now. So we don't know what to do. The best way was to enter here, right here, right? So where everything was here. So it's like a level of $46, $46.50. Now the question for you, based on that technical analysis, where would you put the trade for yourself? Where would you buy it? At what levels? Okay, Ian 45, Dean 45. Any other opinions? 47. Jeremy, wait for next results. Excellent, excellent. All right, so I presume Peter put strike with a 47. You're all right, and I believe that your kind of decision, it's your decision, because you base, for example, I run this masterclass in Russian language, and some people say I buy it right now because I'm going to look at the long term for next year, and I am pretty happy 100% results there. So they didn't care that they can get extra 4% by trying to wait, or maybe missing this opportunity that the company will go up. Okay, so it's all depends on your own strategy. And right now we're going to look at several companies, but you're absolutely right. I would look somewhere at the level of 46, maybe $47. Why 46? Because this is quite strong. It's already kind of fell here and it holded this position. Okay, so I presume that, and it's like before it was strong resistance level. So I expect that traders wouldn't let it go through. It might happen. Okay, everything can happen in the stock market, but I believe that more chance to rebound it back from this particular level. Okay, so that's kind of thing. And Jeremy is absolutely right about waiting for next results, earnings, because during earnings we see all surprises about the company. So you can think about that as well. All right. Possible strategies. We look at 4 strategies. One of them value investing or long-term investing, where you can buy it now, or you can buy it at 46, 47, or can buy it $45 as you put it there. All right, and hold it until 96 to 100. So it might take 2 years for you to wait. okay, but you will be getting 100% profit plus dividends. Can it take longer? Yes, it can. Can it take faster? Yes, it can as well. Okay, it depends on the general economical situation in the world and how company is going to develop. But based on our past past performance, that's what we can expect, and quite huge chance that it might happen within 1.5 to 2 years. Okay, so it's pretty good growth. Now, value trading. If you're a trader, if you don't want to wait that long. Now, who is the value investing strategy for? It's probably for people who are busy at work, who don't have enough time to evaluate the market, who don't have enough options to choose from, and they might be happy with this company and they just buy it and hold it. Okay, and don't maybe high tax payers. They don't want to pay taxes on each trade. Maybe they pay 46% and they would prefer to hold it at least more than a year and then sell it and pay half of the taxes. Now, value trading. For people who are more active in the market, don't worry that much about taxes and prefer to profit more, but be more active in the market. So what you can do here, and if we go back to technicals, so if you buy it here, where would you sell based on technical analysis? What level? How do you assess these levels? What do you think? Come on, guys. $55, Dean wrote. 54, 55, Peter. 55. Correct. All correct. So you can use several. So first of all, trend, right? So it's around 40, 54. By the time it happens, it might be $54. Secondly, you look at this level. Okay, that's again $55. So it might be a support resistance level. Then if it breaks through, it could be $57 level. Okay, so before it goes up. So it's somewhere, sometimes in the future, it might get to a level of 54, 56, 57. Okay, and before it goes higher. Now, what I wrote here, buy 46, 47, sell 54, 56. So it's about the same. So it's about 20% profit if you take all the profit which available there. And how long it could take? Always what I do, I calculate rolls. So if I see it's November and that was end of December, so it's 1.5 month growth, right? So here was a drop, let's say in May. Then we can see the highest point was in June, so it's 1 month. So 1 to 1.5 months we can expect on the growth. Here it's a bit longer, so probably it was January, and then it took May, so 1, 2, 3 months, 4 months nearly in order to reach its peak, but it's much higher and it's made few rolls here on the way, so you could probably wait until March, so it's 1, 2 months, and that would be a maximum point. So we can expect that it might happen similar situation. So we already can see at the bottom end of January, right? It's already half of the February. So it's another month. And you can see if it moves up, it moves quite fast, right? Look at this, 3 days, bam. It was at level of $49 and here it's 55. Very, very quickly. This 20% moves within 3 days, okay? Same story here, okay? Same story here. So if it moves really, really fast, okay? Now, that's second strategy. And the two other strategy, they include options. Now, I took 2 months, March, and I took May. Now, it's actually here, probably will be April tonight when you open the account. It's missing here, and my calculation is a bit off the line because I put 2 months, and I just noticed it now that it's May, it's not April. So your calculation have to be adjusted. But what happens? The share price 47.75, and that's what we can see. So it's a bit less than a month. Here it's about less than 3 months. So what we can see, if we use options, call options, okay, call options on the left-hand side, and there are three strategies. Now, imagine if you buy now at 47.75, you can sell covered call with different strike prices. You can use $50, you can use $47.50, and you can use $45. And the price of the option will be very different. Now, if you sell with a strike price of 45, it means that you agreed to sell your shares below the price you purchased. So you pay 47.75 and you agree to sell it at 45. So $2.75 less, but you straight away getting $3.20 instantly. Okay, so it's like you're making what 45 cents profit, right? In reality, probably when the market opens, you might get more, because look at this last trade price was $3.90, so it's extra 70 cents. But at the moment, I just took whatever we have at bid price. Okay, in reality, it's a huge gap, and you might get more when the market opens. Now, here, when you do it if you believe the share price is going to go down, and you can see the market is high, the ETF index is high. So okay, I don't want to risk my money, especially earnings are coming up, but I don't want at the same time to sit and do nothing. I still want to make some profit on my cash, and I decided, okay, I buy shares now and I sell a call in the money, okay, with lower price. Let my shares to be taken from me, but at least I generate some profit. And we'll have a look now how much we can get. Now, another thing is if you do at the money, it gives you the maximum profit from options like time value, okay, but it's equal actually from any perspective, because here if you move down you get $3.2, quite a lot. Here it's $1.9. And then if you're aggressive, if you believe the share might go up and you're happy to sell it only at $50, you sell call. You get only 80 cents here. Now let's have a look what results. And what I did, I took 2 months. So similar story here. What we see. So instead of 2, it has to be 3 months here. So my calculation is off a bit, but you can recalculate it yourself. So what I can see, that's the strike prices. Strike prices is here. That's the current price. And that's what we get. That's the time value. So if I bought shares at 47.75 and sold it at 45, but I got $3.20, it means that my profit would be $405 by investing $47,750. So I assume that's 1,000 shares. Okay, and my profit would be only 0.85% or 10% annually. It's still much better than earnings from banks, okay, and it's really conservative way. So if you look at your average price of the share, so if what you do, you 47.75 minus $3.20, which you received, if you deduct it, your share price would be 44.56. That's your average price. So, and if you take this difference, it's about 6% in difference. Okay, maybe 5% in difference. So you kind of protect your investment portfolio insured by 10%. So, and if you believe that market has to have correction, you already like average your price down nearly to 6%. Okay, so it's pretty good one in this particular case. Now, if you're neutral, what you do, you get $1.90, and if your shares moved up, you're selling at 25 cents below what you purchased. Okay, so you have to, from $1.90 minus 25, your pure profit would be 165, and that will give you 3.3% profit. If the share price stays below 47.50, you have cash profit 3.9%. Okay, and which gives you about 40 to 47% annual profit. Okay, so which is pretty fantastic. Okay, and if you go for $50 strike price, what happens here? 6.9% if exercised. Why? Because you got 80 cents plus you got $2.25 profit on sale because you purchased at 47.75, sold it at 50. So your total profit would be $2.25 plus 80, so $3.05, which gives you 6.2% of profit or 75% annual if you create deals like that every month. Okay, but it gives you only 1.6% profit if the share stays below $50. Okay, or it will give you 19%. So you see, you have to be right. You have to decide which direction this company to go and choose based on your own, because you can be more aggressive and get more profit. But if you're wrong and share never goes, it's only 1.6%. Okay, so the profitability quite huge in this particular case. And then you can look at the second part, and you can see that here profit would be 3.15%, not 0.85, but it's 3 months. Okay, here 5.3, not 3.3, but again it's 3 months. And here 8.2, so 2% more, but again it's 3 months, not 1. So the longer period you sell options for, the less profit per day you have. Okay, so that's why we prefer to sell options in a short period of time, because you get the maximum loss in option in time value happens within last week. So that's why a lot of people they sell weekly options because they get maximum return on that. Okay, of course you have to take into consideration the time, the premium, like brokerage fees which you have. Okay, about options. Do you understand everything about options? Will you move to sell puts? Okay, clear. Okay, let's jump to puts. Puts right side of this window. So what we can see, also you can be conservative. So a lot of you wrote that you would buy at $55. Okay, 54, 55, 50. Oh no, it's 45. I mean, you would purchase at 45. So instead of sitting and waiting that, okay, I'm going to buy at that price, what you can do, you can tell, okay, I'm happy to buy at $45. I find somebody who will sell me at $45. It drops below 45. So instead of putting limit order, because what you can do, you can set a limit order to buy at $45, right? Or what you can do, you can sell put. When you sell put, you promised somebody that you will buy shares at 45 if they decide to sell it to you. They will sell it to you only if the share price drops below 45. Okay, so it's like you're already guaranteeing this price if the share price drops below. So, but the interesting thing about it that he pays you money or she pays you money. So you say, okay, fine, I'm happy to buy your shares at $45, but you pay me 60 cents for that. So, and they pay. If you guarantee them to buy at $47.50, they will pay you $1.40. If you guarantee them to buy at $50, they will pay you $2.75. Now, who can tell me if I guarantee person to buy at 45 and eventually, and he pays me 60 cents, and when the share price drops down and I purchase it at 45, what would be my break-even price? So what would be my real purchasing price, cost of the share? 44.40, right? Dean, absolutely right. Yeah, Peter, right. So it's much better than 45, which you just covered, right? So, and instead of sitting and waiting in cash, sometimes it makes sense if you are happy to purchase this company. If you, some people say, okay, I'm happy to buy at current levels. Why would you do that when you can just sell put 47.50 minus $1.40? What would be your purchase price here? 46.10, right? So it's much better than 47.10. And the interesting thing about it, if the share price moves up, for example, if you decided to buy the shares at $45 and you set a limit order at $45, and it might never reach this level, never. and it might move all the way to $55. You missed the opportunity. You didn't make any money. But if you sell the put and it moved up, you still keep this money. Okay, it's not huge profit, but still profit, right? And your money works like it's working for you. So it's just fantastic. Similar way here. So let's have a look what profitability you can expect on that particular trade. So that's naked put. Now, majority of brokers, before I explain this table, I want to tell you, majority of brokers, when you're selling puts, they actually don't use all your capital. So for example, if you decide to sell puts for $100,000, so for example, shares which worth for $10,000, you actually need to have only $50,000 on your account. Okay, so your investment part is much smaller. Some people, what they do, they have some shares which are marginable. Okay, and for example, they have no cash at all, but they have shares and they have margin facilities. What they do, they can sell puts and using collateral their shares. Now, it's already using margin. You have to understand what really you're doing when you're doing something like that. But that's why the calculations here is a bit different, because here I have two parts of calculation. First is based on if you're using these margin facilities, and second one, if you don't use these margin facilities. Okay, but again, you have to decide yourself if you want to do it or not. Now, I use sometimes margin facilities in which cases? Assuming that I have shares and I sold call, and I know that next week these shares are going to be taken from me. And I'm pretty sure already, because, for example, share price moved quite a lot, and I know I'm going to get them sold, and I will get cash. And I see perfect opportunity now. So instead of waiting until my cash is released, I can sell put, because I know I will get cash next week. Okay, that's the thing. Or you can sell puts and using margin if you have cash in your bank account available, and you always can transfer this cash into your brokerage account. So always be careful with the using margin. But what can we get? Okay, I'm going to look without margin, but that's what first case. So if you get this 60 cents, all right, and promise person that you buy at $45, you get 1.3% or 15% annual return. Now, guys, do you want to have 15% annual return? Is it better than just money in a bank? I don't know how much in Australia you get, probably what, 1% if you're not depositing them somewhere. Okay, so here 15%. If you do it at 47.75, strikes 47.50, you get $1.40, you get 2.9% or 34% of profit annualized if you don't use margin. If you use margin, it's double practically straight away. Okay, so 6.7% if you do it. Now, of course, if you buy it, you buy it, and that's the cost if exercised. So that's what you calculate, 44.53. That's already including commission. Okay, you gave me your results 44.40 without commission. Here it's already including commission, $16 per trade. I think that's how it calculates. Okay, and that's what we do. In any of these cases, even an aggressive one, your price is 47.38. It's still lower than 47.75. So it's still below the price which you would pay if you decide even to invest right now. Okay, so when you decide what you want to do, what strategy you're going to use, you always have to consider, do you want to own the shares or you don't want to own the shares? Because if you're not 100% happy with the company, okay, be really, really conservative. Okay, if you're happy with the company and you want to buy it in order to hold, for example, a long period of time for 1 year or until it reaches a certain level, you can use aggressive one, okay, and buy it and then hold it. So my strategy most of the time includes that I sell puts and I buy shares through puts, okay, and then when I buy them, I'd rather sell them when they grow, or I start selling covered calls. Now, we discussed these opportunities, and I looked that you're selling all these calls and buying shares right now. But in reality, remember, if we go back to technical analysis, you buy shares here, you don't buy them at 47.75. Despite you're going to use the option strategy, you still buy shares at support. And then when do you sell your calls? You wait until it goes up, and then you sell your call at resistance, because that's how you get the maximum profitability from trading options. Okay, and then when it drops down, you can buy this call back and you can sell it again and use it several times within a month. Okay, and similar story, if it dropped to $46 and you sell put, you get much more for this put than if you sell it right now. So be patient on the market and keep your position open. Analyze few companies, because if you have several companies, one company might never reach the level, but another company will, and you will generate profit for that particular company. Okay, and remember again that markets are high right now, and that's why it's pretty possible that WSM, despite it is undervalued, despite the quality is fantastic, remember, people don't know about that, okay, on the market, and you didn't know about 2 hours ago. And I presume if somebody told you, do you want to trade, and you look at this, technically it looks fine, but still you probably wouldn't buy it. Now you know it, and you know more than other people in the market, but you have to always think about that they don't know about it, okay? And that's why the share price might easily drop, like go down with ETF index fund, and with the S&P 500 and Dow Jones, okay? And it will give you opportunity to get into position even better.